All right, in today's video, we are going to have some fun. We're going to look at a family and their whole life insurance policies and how they plan on using them as the years pass. The fun part about it is that the family has 10 policies. So first we'll go through the companies that they have their policies with, but then we'll look at exactly what they're doing. So the point of contact is mom, who we've been working with for a couple of years. And what mom wanted to see, and what we're going to go through in this video, is all of the policies combined. Meaning, what's my combined cash value? What's my combined death benefit? What do the combined values look like moving forward if we take all of the in-force illustrations? And then what's it look like when I actually use it? So yes, I can request policy loans. She's done that for a long time now. She's got a cash value collateral loan, which means she's taken her policy to a bank and has received a line of credit against the cash value. But wouldn't it be nice, Steve, if instead of always asking you to run illustrations and loan scenarios or asking the bank, if I could just plug numbers in, like wouldn't that be nice so I can just get a quick idea of what loans would look like? Now, the conversation didn't go exactly like that, but that's what we put together with her because she actively uses her policies very heavily for real estate. So we're going to go through exactly that. We're going to look at some projections here. Before we do that though, I want to provide a little bit of background here on the case. So we've got a family with 10 whole life insurance policies. They've got 4 with Guardian. Specific details on this. We've got 2 with the husband, or I should say 2 with dad, and then also 2 with mom, of which for each of them, they can pay $150,000 per year. So total, just with their Guardian policies, $300,000 per year, and their base premiums are about $30K. So that's what they're committed to, the $30,000, slightly more with a term rider, but they can plow additional funds into the policies at leisure up to a total of $300K. Then they've got 4 policies with MassMutual, 3 of which are with their children, and then they've got 1 policy, it's on mom. It is a very old policy that we do have servicing rights to, but what's cool about it, well, I was more frustrated than saying it was cool, is because the policy is much older, we can't even run an in-force illustration with it. We've got to request it from the insurance company. The main reason why is when we plug it into MassMutual's in-force illustration software, it's older and it can't even be run. Like it's got to be used with the old software that we don't have access to. It's like, all right, we'll request it. But then also, she's got 2 policies with Penn Mutual, which we did not put those policies in force. However, since working with her, we do service those policies now. This allows us to run in-force illustrations, track the actual cash value performance, and do everything we do with the policies we did put in place as well. So, purpose of the policies, why she's got 10 whole life insurance policies, is primarily for the cash value. It's viewed as a safe area to position money, and she can also borrow against it for opportunities. She is heavily involved in real estate. The death benefit also provides family legacy planning. You will see the combined death benefit values as well when we go through the actual numbers here. Now, what would be helpful is as follows. 10 policies can be a lot to track. Not for everybody, but it can be a lot for a lot of people, especially when you're dealing with 10 million things on a daily basis. So being able to see everything just combined, like what's my combined cash value? Like some people that receive statements of their current assets and liabilities, if they've got money in several bank accounts, they'll have an assistant provide them with a report saying, here's your combined cash on hand with all of your accounts. This way they can see exactly what they have. And some people have apps that do this for them. But what's my combined cash value on my life insurance policies? And then I'd like to see some hypothetical loan scenarios. So I'm going to go through exactly what we put together for her, which we can provide to anyone who has policies with us. So why we're going to look at hypothetical loan scenarios and why we put this together for her is right here. Example, she sees a real estate deal that requires, we just made this number up, $500,000 of capital. I can finance it with a bank or use my cash value life insurance policies. But if I use my policies, I'd like to see what that actually looks like. Meaning if the interest rate is 5%, 6%, whatever it is, what does it look like if I take that loan? How much do I pay in interest to the bank? What is the policy producing in interest? What's the annual growth? What's also the total gains over 10 years, 20 years, as far as I'd like to look? And then I could simply see, what did the policy grow by each year? What did I pay in interest each year? And did it hurt me or did it benefit me? And I can see it for myself, right? If you've got that hands-on approach. What we will look at first is just the condensed values of the 10 policies. So let's take a look here. And on this Excel workbook, we've got a lot of material here. But what you'll see, if we look at the bottom, the first 2 tabs is what we will look at. Everything to the right are just in-force illustrations of the individual policies. So it took a little bit of time to put this together, but it is fun, honestly. We've got 2 scenarios here. One demonstrates no more payments for 2022 because she's already paid the premium. She's also added PUAs to some of these policies. But then the second scenario displays the values, or displays combined policy values, assuming she makes the maximum PUA payment she can make this year, 2022. So we're not going to look at this one for this example. However, we do send both. This way, if she wants to plug these values into the loan workbook, she's got the option to do that. So to simplify things a bit, let's just condense this or get rid of it. And how we'll get rid of it is not by getting rid of it, but making it invisible. All right. The old policy here. So I wanted to run an absolute worst case scenario that is worse than the worst case scenario. And what I mean when I say that, we've got the old policy, the cash value and death benefit, and this is the cash value and death benefit based on the present status report. We ran this a couple days ago. So what I ran here is assuming that the values just remain exactly where they're at forever. It has been appreciating. It will continue to appreciate based on the guarantees alone, but because we don't have the actual values yet, I don't want to plug in a hypothetical or anything like that. All of the values we see over here are all based on the actual in-force illustrations, as we just export all of the data from the software right to the Excel sheet. Except for this, what I did was just add $41,000 in cash value and $41K to death benefit. So right now, on her status reports, if we take each individual online account value, $712,000. The end of 2022, the end of each policy year, the combined cash value will be $725,000. Look at that death benefit. From a legacy planning standpoint, that's a lot of money that can be purposed for the next generation. They have a trust in place, so they can set it up where the death benefits are paid to the trust, and it specifies, the trust does, how much money should be used to purchase new policies, what the money can be used for, what the money should not be used for. A lot of times you'll see that when it comes to trust planning and such. So let's take a look here. What I want to do actually is take these calendar years. When we go to the loan workbook, I'm going to update this. Okay, we've got our years in here. So the combined values, what we want to look at here, 2022, no more payments, value at the end of this year, $725,000. We've got the annual internal rate of return, the net growth rate, just taking that combined cash value as the years pass, the illustrated payments, funding the policies up to the max through 2029, and then paying just $20K per year thereafter. And what that $20,000 is one of the kids' policies that she's funding at $20,000 per year. So the IRR is based on that total cash value balance over time. The IRRs for each policy is different, obviously, because different companies have different dividend rates. But again, this just gives you the total IRR on an annual basis with that combined cash value. Then we've got dollar amounts, cash value growth. Here we go. And this is the net growth. We are not factoring in our payment here. So this is just what I'm receiving in dividends and interest from the insurance company. And then total growth will tally up all of the annualized numbers. For example, if I look at by 2030, if I tally up these numbers here, they'll equal this, $734,000. Now, what this does not give us is the total gains from day one, because some of these policies are several years old. So in order to do that, we would actually go back, pull the annual statements and look at what was actually paid in dividends and interest, what was your actual cash value and death benefit year over year for that older policy. That will take some time because we do that manually. When I say manually, we get the statements from the company and then export them to Excel manually one at a time. So this is just everything moving forward. So loan workbook here, when we look at this guy, cash value collateral loan. So she's got everything consolidated here. We don't want those ages because the ages vary. We've got the husband, wife, and kids. LTV 95%. So this is a workbook. Showed her how to use it via a recording, and then she can use it as much as she'd like. What it is meant to provide her with is just a quick scenario, what if scenario. What do things look like if I take a policy loan? How much do I pay in interest? What do I actually receive in total growth, dividends, and interest? And then what do things look like before I look at the actual numbers with the bank or with you, Steve, when you run the scenarios for me? What do things look like? So here we go. LTV at 95%. This will always pull from your total cash value. So here, if I've got 725, if you take a calculator and just take 95% of that dollar amount, you'll get this, just about 689. Available equity. If I don't have any loans outstanding, the available equity will always match the LTV at 95%. Why that's 95% and not 100% is because most banks, not all of them, but most banks that offer cash value lines of credit will give 95% of whatever the total cash value is in a line of credit. Some are 100%, most are right around 95%. So as we look at this guy, 689 and change available equity. Now, if we go back to the whiteboard, what was the purpose of this workbook? If she has a real estate deal and wants to take, let's say, $500,000, instead of asking, hey, how much will that actually cost me in interest? What's the policy growing by each year? Is there a way I can just get a quick projection? Which that's what this is. These do not show 100% accurate numbers. It just allows someone to get a quick idea of what the numbers might look like. And then when we get the formal numbers, they'll be close. But again, it's just a quick idea so I can make just that shoot by the hip decision there. Not that I like to shoot by the hip, but I think you know what I mean. So let's take a look here. If she wants to borrow $500,000 to invest in a piece of property, say that's this year. You know what, we're at the end of 2022, so say it's 2023, say it's 500K. What happens here? We've got the interest rate at 6.5%, which right now is higher than what you would actually have or what she even actually has right now. But again, we're gonna run this conservative. She can change this over time if she wants. Year to year, we can make the adjustment. But if we leave it at 6.5%, how much am I paying in interest this particular year? So I see the loan balance, then the interest due, and then the interest payment. Interest due will always match the payment. When I look at this guy, $32,500. That's what I paid to the institution. What did I earn? What did my cash value grow by? $15,753. So in this particular year, if this is you, did it cost you more? Did you earn more in dividends and interest? Or did you pay more in interest? Paid more when we look at it. How about the next year? Let's assume you don't make any loan payments and your loan balance stays at $500,000 and the rate does as well. You pay $32,500. What did the policy grow by? $37,500. So did you earn more or pay more? You earned more. Now the reason why, because if I look at the rates here, the internal rate of return, which is the net growth rate this year, is 2.35%. However, the interest rate is 6.5% that I'm paying on. So how am I earning more? Well, how you're doing it is that 6.5% is on $500,000, whereas that 235 in this example is on over 1.6 million. That's why I'm ahead. So what we can do here, if we want to look at different scenarios, is let's assume we pay this loan back. You know what? She's funding this policy aggressively, so I'm not going to illustrate any repayments through 2029 because there's some heavy payments going into the policy. She might do it, especially when she receives, if she receives any large lump sums from the syndication deals, but at the same time, for this example, let's not do it. Let's model paying more interest. And why don't we do this? Let's take out $500,000 loans each year. So we're going to loan this out pretty aggressively. Like, look at our available equity here. I don't know if she would actually do this just based on her history of using the policies, but still, let's make it aggressive. What I mean when I say aggressive is trying to pit things not in our favor, against us. So what I mean when I say that is this. $500,000 draws here. $3.5 million in the loans, or an outstanding loan balance. Interest due, $227.5. Interest paid, $227.5. This calculator will always assume we pay the loan interest. Now, in this particular case, if that becomes too high, what I would do is scale down the premium and PUA payments and redirect some of those payments toward the loan interest, which would then restrict the amount you could loan. This is the kind of stuff we want to discuss over the years when we're taking loans, but there would definitely be some things I would recommend here if I see this going on, or if we discussed it during review meetings. Anyway, here, 227. What did I earn this year? 145. So I'm behind. Now, if I just pay interest only at 6.5%, when do I catch up? Take some time here. 2037. Let's pay the loan back because we would be doing that in this particular case. And let's start to pay it back. I'm going to go aggressive here because if I run it at 100K per year, it'll take 35 years. Let's put it at 300. You can pay it back however you want. Most people in this case will be paying it down while they're taking loans, but let's just pay it down here. By the way, if death occurs while loans are outstanding, if a collateral assignment is outstanding with the bank, that death benefit will be used to help satisfy the repayment. All right, here we go. So paying it back at 300K per year, 200 in the last year. Also paying the loan interest out of pocket. So these two combined are her actual out of pocket, which when we look at what she was paying in and now she's not paying as much in, she's redirecting premium and PUA payments toward loan principal payments and interest for that matter. So what we can look at now is again this. So let's look at interest paid on a yearly basis compared to what we're growing by each year and see what it looks like. And what do you notice here? With those heavy loans outstanding, there will be years when I'm behind. However, once you start paying it down, you'll find very quickly you can balance it back in your favor. Again, my point here is not to say that it's a good idea or a bad idea. The point is to provide the same thing I'd want, which is just awareness. To know, am I ahead or am I behind? This way I can make an informed decision, and if I'm behind, I know what I have to do to get ahead. At the end of the day, the IRR and the policy, that combined cash value, is still an attractive place to position my funds, being that it's going to produce a greater IRR than what I earn in my bank account. I've also got the safety that'll continue to compound over time, can access it whenever I want, and then tax-free. Tax-free if I don't mech it out and trigger a taxable event. But here, paid back, and let's take a look at this, paid back by 2040. Total growth, 2.9 million. What's your total interest paid? 2.125 million. So that's how much interest I've paid in this example. This assumes 6.5% interest cost forever, but what offsets that is the fact that the total gains are 2.9 million. So did I come out ahead or was I behind? I was ahead. And again, just being able to see this is what helps more than, or what helps individuals more than anything else. So she's got that workbook. She can always play around with the figures and such. And when she has questions, she can reach out. And that's what we like to do with folks we work with looking to use their policies. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. It does help us. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.